Most retirees believe the biggest risk to their future is the stock market. They worry about downturns, recessions, or whether their portfolio will grow fast enough. But here's the truth. The market is not usually what derails a retirement plan. The real danger is much quieter. It does not make the headlines on the evening news. It is taxes. And here's why that matters. Imagine two couples, both with $2 million saved for retirement. On paper, they look identical. But fast forward 10 years, one couple is traveling, gifting to their grandkids, and living stress-free, while the other is cutting back and stressed out about running out of money. The difference wasn't investment performance, it was how much the IRS took. That's why I call taxes the silent retirement killer. You don't see them the way you see stock charts, but they quietly drain your income year after year, and unless you plan for them, they can do more damage to your lifestyle than a market downturn ever could. Hi, I'm Mark Wisniewski, President of Southern Income. For over 20 years, I've helped pre-retirees and retirees protect their savings and create reliable income strategies that don't just focus on investments, but also on taxes. In today's video, we're diving into why taxes matter more than your portfolio returns, the traps most retirees fall into, and some strategies that can help you keep more of what you've earned. If you find this helpful, don't forget to like and subscribe. And if you'd like a personalized retirement tax plan, you can book a time with me using the link in the description. Part 1. Why taxes are the silent killer. When you're working, taxes feel straightforward. You earn a salary and taxes are withheld, and what's left, that's your take-home pay. In retirement, it's far more complicated. You have different types of accounts, 401ks, IRAs, Roths, brokerage accounts, and each one is taxed differently. Here's the problem. The rules for retirement distribution are not designed to maximize your income. They are designed to maximize government revenue. Think of your retirement like a leaky bucket. Your investments pour money in, but every withdrawal comes with a leak. And taxes are often the biggest hole in that bucket. And if you don't patch it, it won't matter how much water you pour in. The bucket just keeps on draining. The danger is that taxes, they're not obvious. You won't get a letter in your 50s warning you that your future RMDs may put you into a higher tax bracket. You'll only discover it when you're already locked in. Part 2, the 3 biggest retirement tax traps. Let's look at the main ways retirees lose income to taxes. One is required minimum distributions, RMDs. At age 73, you must start withdrawing from your 401k and your IRA accounts. Whether you need the money or not, those withdrawals are coming out and they're taxed as ordinary income. For example, a couple with $1.2 million in a tax-deferred account, they may see required withdrawals of $50,000 or even $60,000 every year. Add in Social Security, and suddenly they're pushed into higher tax brackets, even though their spending hasn't changed at all. 2. Social Security taxation. Social Security can be taxable depending on your provisional income. Many retirees don't know this. Up to 85% of benefits can be taxed if your income is above certain thresholds. Imagine expecting $40,000 from Social Security, only to discover $10,000 or even more may go to taxes. That's a painful surprise if you didn't plan for it. 3. Medicare IRMAA surcharges. This is one that blindsides even the wealthiest retirees. Medicare premiums increase if your income crosses certain thresholds. A couple filing jointly can see premiums jump thousands per year just because of a large withdrawal or Roth conversions or selling investments at the wrong time. These 3 traps work together. An RMD pushes your income up, which makes more of your Social Security taxable, which increases your Medicare premiums. It's like the domino effect of hidden taxes. Part 3, why investment returns cannot fix a tax problem. Let's compare two retirees. Retiree A only focuses on investment, and they average 8% return. But because they didn't plan withdrawals carefully, 30% of what they take out, it's going to taxes. Retiree B averages a more modest 6% return, but with smart planning, they reduce their tax bill to around 15%. Over 20 years, retiree B actually ends up with more spendable money. Why? Because they kept more of what they earned. You cannot control the market, but you can control how and when you withdraw. That's why I often tell clients a strong tax plan can be worth more than just chasing higher returns. Part 4, tax smart strategies that can help right now. Let's talk about solutions. These are not guarantees, and they're certainly not a one-size-fits-all, but here are 4 strategies many retirees use to reduce their tax bite. 1. Roth conversions. Converting portions of your IRA into Roth in lower income years can set you up with tax-free income later on. For example, a couple retiring at 62 before Social Security kicks in, they might have several years where they're in a very low bracket. That's the window to move your money into a Roth. Done right, it can mean lower RMDs and lower taxes way into the future. 2. Withdrawal sequencing. The order you tap accounts matters. Sometimes it makes sense to draw from taxable accounts first, then tax deferred, then Roth. Other times, a blend might work better. The right sequence can stretch your income by years. For example, if you're 65 with a mix of IRA, Roth, and brokerage assets, pulling small amounts from each may lower your total tax bill compared to just draining one account at a time. 3. Managing capital gains. Selling appreciated investments at the wrong time, that could push you into a higher tax bracket. But spreading sales out across years or using gains in years with lower income, that can reduce your tax bill. 4. Charitable giving strategies. For those of you who give using qualified charitable distributions or QCDs from your IRA after 70 and a half, can satisfy RMDs while lowering your taxable income. That means you give to causes you care about and keep your taxes lower, all at the same time. Part 5, the high net worth angle. For many high net worth families, taxes are often the biggest expense in retirement. A couple with $5 million in retirement accounts, they may see required distributions in hundreds of thousands of dollars per year. Whether they need that money or not, that income increases Social Security taxation and Medicare costs. And in some cases, it triggers estate tax concerns for their heirs. The wealthier you are, the more planning matters. Investment growth is important, but without a tax plan, the IRS may be your largest single beneficiary. Legacy strategies like trusts, gifting, and charitable planning all come into play for high net worth families. But again, it must be done carefully and coordinated well in advance. Part 6, what to do next. So, what should you take away from all of this? I'd say if you're 5 to 10 years away from retirement, this is the prime window for Roth conversions, adjusting savings vehicles, and coordinating when you'll claim Social Security. It can all pay off down the road. If you're already retired, you still have options. Coordinating your withdrawals, spreading out capital gains, and even making charitable gifts. It can all make a meaningful difference. The key is this: don't let taxes sneak up on you. They are predictable if you plan ahead. Taxes are the silent retirement killer because they don't show up in a market chart. They show up in April and in the lifestyle cuts people are forced to make because they did not plan. But with smart strategies, you can minimize the leak in your bucket and keep more of what you've worked so hard to save. If you want help building a retirement income plan that considers both investments and taxes, book a call with me using the link in the description. And don't forget to subscribe for more practical retirement strategies.